on if that helps anybody. Okay, so let's go ahead and just make sure that we remember back from learning objective 2 that there were a few different things about managerial accounting. One is its emphasis and focus on manufacturing. And so manufacturers create and design and make products. Okay, and so it's important to sort of understand that. So you learned about manufacturing costs being into 3 categories. Direct materials, so they need to buy raw materials. They need direct labor, and they need to categorize what we call manufacturing overhead costs, right? Anything that's revolving around making a product would be part of the manufacturing costs that we learned about here. You learned about raw materials and direct materials. You learned about indirect materials in that part of the chapter. So if it's a direct material, it's used in the product. And so it's technically part of the manufacturing cost. If it is an indirect material, it might not be used in the product, or there's so small a trace of it that it's hard to get a cost down. So we consider that part of manufacturing overhead. Direct labor, as you learned, is about specifically involved in creating the product. Indirect labor, they don't have any physical association with the product that's being made. Right? So the payroll accountant doesn't make the automobile in a factory, for example. So that would be indirect labor versus the persons who are on the factory floor making automobiles, direct labor. And anything that's involved with the actual factory itself, cost regarding that is the manufacturing overhead. And so these are the areas that we looked at. These are directly related to the product, and so they're considered product costs. Okay. Now it's interesting because what we're learning in objective 3 next is that because these are actual product costs, they're actually part of the inventory of a manufacturing company, which is quite different than any other business. A period cost, as we learned, is definitely an expense, but it is not manufacturing based. Okay, so it involves all the selling expenses and the administrative expenses. So this is what we learned the last time we were together, looking at the differences between a product cost, which are directly related to the manufacturing of a product, and a period cost, which doesn't specifically relate to the manufacturing of a particular product, direct manufacturing of it, but it's part of the cost of the business. So we did this whole list, and I think for the most part, many of you did a great job in understanding the differences in here. So and a lot of folks did great on the do it exercises number 2, which is great. All right, so learning objective 3, this is the real heavy lifting in this particular chapter. And it focuses on 2 financial statements that you're very familiar with, the income statement and the balance sheet. So first, the income statement is important because in manufacturing, just like in merchandising, as you learned in financial accounting, there's a cost of goods sold. It's just computed much differently for a manufacturer than it is for a merchandiser. You probably remember that all the way back from chapters 5 and 6 back in your financial accounting class. We did the merchandiser piece. So let's take a look at the merchandiser. You might remember from Accounting 104 that merchandisers have beginning inventory in the store. They purchase a whole bunch of other inventory, right? Then they subtract out what's left at the end of the period, and that's how they get their cost of goods sold. That's what we learn in financial accounting. In managerial accounting, we're looking at things, in this case, from the manufacturer's perspective, right? The company that's actually making the product. So here they have something called beginning finished goods inventory. Right? So to be a finished good, it's ready for sale to another retailer. So for example, a car manufacturer, the finished goods would be the cars that are ready to roll and be sold to customers. That would be different than goods that are still work in process, where there might just be a chassis with a bunch of things attached, but no wheels, no engine. So they sort of make differences there. That's important. So beginning finished goods inventory. They add to it a lot of what we talked about in this part of the chapter, which is cost of good manufacturing. There's schedules on how to figure that out. They subtract out the ending finished goods inventory, and that becomes their cost of goods sold. So what you should be getting out of this particular statement, which is illustration 1.6 in your book on page 13, is simply that there's formulas to follow. There's a mathematical formula to follow to calculate cost of goods sold. Okay, you're gonna be focusing in on the formula for the manufacturer in order to calculate the cost of goods sold. So again, there's two different income statements here, partial income statements. On the left side here, you have the merchandising company. Again, this is retail. Retail, their cost of goods sold is simply the beginning inventory plus all of the goods that they purchased, right? That gives them the available goods for sale. Then they subtract out what's left at the end of the period. What's not there is considered sold, and so it's cost of goods sold. As you see, for a manufacturing company, it's slightly different because the cost of goods sold starts with the finished goods at the beginning of the period. Okay, now that number will be given to you. It would be available on a balance sheet. Okay, finished goods inventory. We're going to look at illustration 1.9 very soon to show how they calculated the cost of goods manufactured. That gives them the total cost of goods available for sale. They subtract out what's left in their inventory at the end of the period. The difference is assumed to be sold. And so they have a cost of goods sold that's done this way. So again, it's really important that you understand that there's somewhat of a formula to follow to calculate these. Once you get that, plugging in those numbers won't be so bad. So how does a manufacturer determine these things? Well, that's what this slide shows us. And if you are in the book, this is at the top of page 14, illustration 1.8. So first thing that we need to do is start with the beginning work in process inventory. Now remember, work in process. So it's, it's not raw material and it's not a finished good. It's in the process of becoming a finished good. So they take raw material, which could be blocks of wood, right? Large blocks of wood. And that's a raw material. There's a work in process that goes on. And then at the end of that, you have basically finished goods for sale. So this focuses on the work in process, stuff that is in the process of becoming a finished good. So they take the beginning work in process inventory, they add the manufacturing costs, and that gives them the total cost of all that work that's in process. Then they subtract from that the ending inventory for work in process, because that's still work in process. And that gives them the cost of good manufactured. Again, this is a formula that you'll see play out in the structure of the financial statement we're going to be looking at next. Okay, so again, this is illustration 1-8, page 14, very top of the page, the book. This is what it looks like in a schedule. It's the same exact thinking that we looked at earlier, but this is what it looks like in the schedule. And here, this is about a surfboard company, Current Designs, that's explained in your book. And this is their cost of good manufactured schedule for the year. So again, they start out with their work in process for the beginning of the year. So on January the 1st, this particular company had $18,400 of work that was in process, okay, from the previous year. That's their starting point. What they do then is they take all of the direct materials. So in this case, it's the beginning raw materials from January the 1st. They add all of the purchases of raw materials through that year. That gives them the total raw materials they have available to use in the process. Then they subtract out the ending raw material at the end of the period, which is December 31st. The rest, or the difference, is considered the direct materials that they've used that year. So these numbers are basically there to calculate the $146,400. And it's a step-by-step, right? January the 1st inventory, all the purchases for the year, that gives them the total amount of inventory, raw materials inventory. They subtract out what's left at the end of the year, the rest is used. And so direct materials used will be listed here. The second thing they look at is direct labor. Oftentimes that's a given. So that number often is just given to you. Sometimes you do have to calculate a few things, but right now, no, that's good news. Manufacturing overhead. Again, anything that is related to the factory, right, that isn't direct material or direct labor. And so you have indirect labor, factory repair, factory utility, factory depreciation, and the factory insurance. So this is the total manufacturing overhead listed here. When you add direct materials, direct labor, and overhead, manufacturing overhead, you get $376,800 in total manufacturing costs for that year. You add it to the work in process, and that gives you total cost of work in process of $395,200. Then they look at the end of the year. This is a December 31st statement. And they say, okay, what do we have in work in process right now? Well, they have $25,200 of work in process right now. And the difference between those numbers is the cost of good manufacturing. Okay, so this $370,000 is the cost of good manufacturing. Now that's exactly what we just did. What we looked at here is exactly what that previous table or illustration was telling us what to do. Just that was in a formula. This is actual looking at line by line. So this was one of the most, this was the most challenging schedule you had to put together for this part of the homework. And this just simply takes time. It's really not terribly complicated, but it just takes time to make sure we're plucking the right numbers out and putting those in, okay? So here, this was on page, the bottom of page 15 and the top of page 16 is simply the do it exercise for this. And it shows here information about Keystone Company. And it asks us, and this is just for March, right? March 1st to March 31st. And it asks us to prepare exactly that same schedule for this company for March, okay? All the information we need is right here. So as you know, we start with the work in process as of March the 1st. And that's given to us remember, we're looking back at this. That's given to us here, $2,500 is the work in process inventory as of March the 1st. Okay. So then what we're doing is we're taking that and we're adding in, excuse me, those direct material costs. Well, what information do we have that's specific to direct materials? Well, we have raw materials as of March the 1st of 12,000 that are listed. We have $90,000 of raw materials that we purchased that month. So we have a total amount of raw materials of 102,000. Once we subtract out the end of the month's raw materials for March 31st of 10,000, we'll see that we've used $92,000 of raw materials in the month of March. Okay, so there's some calculation that we have to do that looks exactly like the schedule you just looked over. We simply subtract out the, we add to that the direct labor costs, which are given to us. And we have to calculate the manufacturing overhead, okay? So total manufacturing costs for the month of March, $387,000. We had work in process at the beginning of March of $2,500. So when we add those two together, the total cost of the work in process for March was $389,500. We take that, we subtract out the work in process that's left on March 31st of 4,000, and that gives us our total cost of goods manufactured for the month of March of $385,000. So this cost of goods schedule, manufacturer schedule, is an important schedule to know for this chapter, and it is the most time-consuming thing to put together in this chapter. But it's not terrible. It's just not terrible. Time-consuming? Yes. Terrible? No. Another place that differs between a manufacturer and a merchandiser is on the balance sheet. Because on the balance sheet, merchandising companies like retailers only show one category, inventory. That's it. For a manufacturer, they're actually creating these goods. And so they actually have three categories that are important. First, they actually have to buy the raw materials, okay? Purchasing those raw materials is really, it's a temporary asset for the company, okay? So it becomes part of the inventory account for a manufacturer. And then, of course, they are working to process that into a finished good. So any work in process is also technically part of an inventory of a manufacturer. And then, of course, what we all know, once it's all finished, that finished goods inventory from a manufacturer can now be sold to other businesses that can sell it to us. So one of the big differences that you have to know here in the balance sheet is that inventory accounts for the manufacturer are kind of broken into three pieces. The actual raw materials that they purchased, the actual work in process inventory, so things that they're still working on, but they're not done. And what's done is finished goods. Once it's a finished good, it can be sold, okay? And so you'll see that this is simply the current asset section of a balance sheet. And here on the left side, you have the merchandising company, which simply has inventory as one big account, no separations. But in manufacturing, because they're actually creating the inventory, they want to show basically what they have. So they have in this case, this company has $80,000 of finished goods that they can sell to other businesses. They have $25,200 of goods that are in process. And they have $22,800 of raw materials that have not yet been started to be processed. Okay, so this is a big difference here. This is on page 15 in your book at the very top, illustration 111. And it's just to show, again, for a manufacturing company, inventory is going to be looked at and accounted for slightly differently than a merchandising company that you're familiar with from financial accounting. Okay, so I'm going to stop there temporarily, bring us back to our main group, see if everyone can kind of turn on their cameras for a moment, and ask you if there's questions on what we just went over for Learning Objective 3. Again, that's the most heavy-handed one. Okay, Dan, go ahead.
So I don't have a question about the material. I just want to apologize because I had to switch computers, so I actually don't have a camera.
Oh, okay. Then you are forgiven today. But only today, Dan. Sounds good. Okay. Any questions on Objective 3? Did that go okay? Again, I think it's a little time-consuming, but it flows. It just takes a little bit of time to plug in the numbers as to where it is. But once you have that structure down, you should be fine. Should be okay. No huge problemos there. But that's going to take you the most time, right there. Right? No questions. No preguntas. No. Okay. So I'm going to go back to the slideshow. We're going to wrap up this chapter, Learning Objective 4. Okay, so Learning Objective 4 is just some basic reading that's important. And there's a couple of very important aspects of this that's going on right now, that's affecting us right now, that we can talk about. So first of all, even though we've been talking about costs from a manufacturer's perspective, there are service industry, service businesses also use managerial accounting techniques to calculate their costs. It's something that you'll see periodically through the book as we go through. It's not the huge focus or emphasis in this particular course, but it is something that applies to all businesses. Okay, they need to know their costs. Okay. So this is interesting. I don't know if you've ever flown Allegiant Airlines. I have several times. And this particular story on page 17 in your book is actually quite interesting because it shows here that while a lot of other airlines were cutting services, Allegiant Airline actually increased their capacity 20%. How do they do it? Well, actually, it's interesting because they have some of the highest profit margins in the airline industry, which is important today because, of course, not that many people are flying compared to before. Notice that their average one-way fare is only $83. How do they make money? How do they make money? They make money because they control costs big time. Okay, they control costs big time. First of all, they only fly used planes. And there's nothing wrong. I say, oh, a used plane. Well, people buy used cars all the time, used trucks. I mean, it's the same. It's a used plane. So it's better to pay $3 million for your planes than $40 million because it just lowers your costs quite substantially. They don't fly out of big airport hubs. So Allegiant flies out of Newburgh, for example, very close by Stewart Airport. But you're not going to find them in a lot of big cities because the costs of flying out of a big city and having a hub there is very expensive. Whereas, Newburgh is, the Stewart International Airport, they're practically, not that they're giving away their space, but it's very cheap to have an airline there. The company only flies to certain places, so they don't have to keep their pilots and other flight crews at hotels. So they tend, so the whatever's flying on a Newburgh, these folks are local, and so they might be flying to Myrtle Beach or flying to Florida, but they're flying back, and they don't have to stay at hotels because they're back home. Okay. Plus, their planes are almost full all the time. They average about 90% capacity on their planes. And so Allegiant Airlines knows their costs down to the penny, and keeps things on the cheap. So, that's how they do it. But it's important. And that's a service airline. Airlines are service businesses. One of the things that we are affected by big time these days, since the last several months, is what we call a value chain. And the value chain basically refers to all the processes in providing a product or a service. This has come to grips with our PPE, masks, other types of protective equipment, and certain things that we really rely very heavily on, for example, China for, that's healthcare based, certain components of testing and other stuff like that. And I'm talking specifically about our COVID crisis. But here what we have is a value chain that, once you acquire raw materials, once you do production, sales and marketing, you have to deliver. And then of course you have to make sure customers are satisfied. Well, if all of this is taking place in one particular area, or most of this, particularly the raw material piece, the production piece, the delivery piece, is coming out of one country, and that country has problems. So that was the start of coronavirus. Well, then it's going to affect everybody. And you saw that happen in real time as China was suffering in January, February, March with coronavirus problems. It affected the supply chain. In essence, it affected the value chain. And so when you and I really needed certain things, we couldn't get it. Well, because that chain was basically broken. And it created a large problem. Actually, it was very insightful because now companies today have to decide, do they stay with the same old value chain that they've built? Or do they really kind of need to change how the value chain is done? And so we can either do more stockpiling of inventory, which has been a big no-no in businesses, or we can create a chain that doesn't rely specifically on one country or one particular area. So when something happens there that's negative, it won't affect us. And what I mean by the no-no of inventory is something that businesses have basically flocked to in total, just-in-time inventory. Means basically there's no inventory in the store. That basically if stores find that there's something that's a hot product, they simply order it and it comes to them within a day or two. That's just-in-time inventory. So, and that happens all the time. If I need computers or if I need iPhones, or if I need other types of stuff, and I see that the demand is there, well, there's nothing stopping a US manufacturer like Apple from putting in orders at the factory in China and getting those shipped the same day, later in the day, and in the States for the following day or two. And there's your just-in-time inventory. So there's no, what a lot of companies have decided to do is not have much inventory. And that's terrific if you are all efficient and everything is fine. But when you have a crisis like what we had several months ago, the start of coronavirus, where we couldn't even find enough masks for the people who use them at the hospital, doctors, nurses, etc., or protective equipment for them. Well, it's because of the just-in-time inventory. They just didn't have any stocked up, right? Because if they needed something, they could just order it and it would be there the next day or two. Well, that doesn't work when you have a crisis. And I think that's one of the issues that we'll see change over the next year or two as companies decide, well, how much of this just-in-time inventory method uh, is, is appropriate for us. Do we use it for everything? Because right now it's being used for everything, not just the shoes that you might buy at your local shoe store, but for important stuff, medicine, um, healthcare supplies, other types of things. They're all using just-in-time inventory. And of course, we just saw as a country over the last 6 months exactly what happens when you rely specifically on one particular method. It doesn't quite work. So that's going to be interesting to see how that plays out. Okay. Another part of the value chain that's important is no defects, right? And the goal, zero defects, no defects in product manufacturing. And what we found is that for the most part, as manufacturing has shifted to robotics, computerized manufacturing, there has been significant reduction in the amount of defects in products. And so, of course, it depends on the product. If the product has 1,000 different parts versus another product that has 10 parts, chances are the product that has 1,000 different parts, there may be a defect versus the product that only has maybe 10 parts. But nonetheless, we have gone to an automated manufacturing system with more emphasis on robotics. We've seen that defection rate come way down. There are certain things that are part of this value chain that's important to understand. One is that, well, and we're learning about our bottlenecks. What types of bottlenecks limit the company's profitability if they're going to be focused on a particular value chain that they have right now. So I think what we know is that companies had to, because we couldn't get certain supplies, certain raw materials, et cetera, companies had to shift the products that they made. And so companies had to stop producing certain specialty foods and focus on basic foods. They had to stop producing specialty items and focus on basic items like toilet paper or what have you. That is part of these bottlenecks that are set up when you can't get your raw materials to make stuff, right? That limits the profitability of the company because it limits what they can sell. So we've been through, actually, it's interesting that you're taking this particular course at a time where all of these things are being talked about currently. Because what COVID has provided us as a pandemic situation is there are a lot of bottlenecks. And so how do companies get around them, really? Well, one thing that companies need to do always, regardless, is make sure they know their costs. Everything that's done has a cost to the company. And so they want to make sure they know their costs. So there's a bunch of different systems that you're going to be learning about in this class. One of them is called activity-based costing, or simply ABC. And you'll learn that in a future chapter. But this is something which basically helps us get more accurate costs in producing a product. You'll also be introduced to something called a balanced scorecard. It's actually, I think, a topic in a future chapter, like a chapter 11 or chapter 12. But you have to, yes, costs are very, very important. Financial issues are extremely important, but there are other non-financial measures that are also important. And companies have to sort of balance all of that to come up with objectives that are quite reasonable. Oh, yes, ethics. What can I tell you? they're interesting that to say they say all employees are expected to act ethically. Yes, managers included. Managers included. And so, basically speaking, a lot of the fraudulent activity that's happened over the past 20, 30 years have almost always been financial based fraud. And so even though companies, and all companies have a code of ethics, and you and I know the difference between what's right and what's wrong, it doesn't stop these types of things from happening. So basically, anytime there's a fraud, you're lying to somebody important. It might be your owners, stockholders, might be to others that have a financial interest in the company. So systems have to be created, and the law is new. Sarbanes-Oxley is the law that says, look, you have to take these types of things seriously. And for the very, very first time, management and their top folks have to sign off under penalties of perjury, basically, that the information, financial information, otherwise is true. Otherwise, they can spend time in jail. They can spend time in jail. That's the first. This happened around 2001, 2002, around that area, early 2000s, after Congress decided enough was enough, and that's hard for them to do. But as you see, there was enough problems that they had to act, and they did. So you'll learn a little bit more about Sarbanes-Oxley as we go. You've actually learned about it a little bit already in financial accounting, was mentioned a few times. Again, it just continues. And then we have issues of, social responsibility, to have, sustainable business practices, right? Sustainable meaning they're going to last for a long time. And so if you trash the environment or don't treat people well, it's kind of hard to have a business model that's sustainable that way. And so a lot of businesses have what they call a triple bottom line. They look at the company performance as it relates to people, as it relates to the planet. Are they good to the planet? And obviously financially, are they profitable? And so this is a big part of what we call corporate responsibility. And that is how it ends. There's this particular do it exercise is already done for you in the book. So I'm going to stop the recording.